Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. Let's get you up to speed on the market action. 1 hour left to go in the trading day, and we are seeing green across the board. The S&P 500 looking to notch its fourth straight day of gains, trading above that $4,500 handle right now. The Dow also up 43 points there. The Nasdaq up 83. Stocks moving higher despite more signs of economic slowing. Those ADP private payroll numbers coming in this morning, weaker than expected. Annual GDP also revised downward to 2.1% growth. And we have seen some of the Treasury yields pulling back on the back of that data. Let's do a quick check of where the 10-year yield is trading. It's at 4.12%. Also, crypto reversing course today, giving back some of those gains that we saw from yesterday after they got that lift to tied to a D.C. Circuit Court judge, essentially saying the SEC must reconsider Grayscale's launch of a spot Bitcoin ETF. Looking at where Bitcoin is trading right now, down about 2.5%, and Ethereum down roughly 2%.
Right, Kiko, well, it's all about the econ data that was out this morning, and investors, they're sifting through a number of reports today. The latest reading on second quarter GDP showing a slowing growth in key areas across the U.S. economy. The print was revised lower to 2.1% on the heels of declining business investment. And U.S. job growth also pulling back in August. Private employers adding 177,000 jobs, less than half of what was added in July. All of this ahead of tomorrow's PCE report, the Fed's preferred inflation gauge. Now, despite the sluggish readings that we did get on the economy, stocks, though, like Akiko was saying, are up. So is bad news actually good news for the market? We want to bring in Tom Hayes, Great Hill Capital Chairman and Managing Member. Tom, it's good to see you. So certainly we've heard Fed Chair Jay Powell, the Fed, waiting for the economy, waiting for some of these data points to weaken just a little bit because we know what that means for Fed policy. It seems like investors are a little bit encouraged by the disappointing reports.
Yeah, I think we finally have a Goldilocks scenario where the slowing is starting to kick in, the lagged effect is starting to kick in, and more than anything, what that means for the Fed is it gives them cover to actually pause in September, which is kind of priced into the markets right now. And then we have till November, which everyone thinks there's going to be a hike in November, but we're going to get a lot of inflation data between now and then. We're going to get a few jobs reports between now and then. And looking at the ADP data today, we're going to see the jobs report on Friday. If those numbers continue to come in a little bit softer, the Fed may be done in terms of hiking, not done with tightening because they'll keep rates elevated for a little while. And that creates this perfect scenario for stocks moving forward. You know, a lot of people are very nervous about August and September seasonality right now. But there's a caveat to that. Since 1905, in the years that the S&P is up 15 to 20% by July, the remainder of the year on average is up 9%. So with all this fear, I think people are underestimating the amount of cash that's still on the sidelines that has to play catch up for underperformance in the first half of the year.
And Tom, we'll talk a bit about how you can play with that cash. But on Fed policy specifically, there's been a lot of talk about the lag factor and how much room we have to run essentially on this data. What does the data today tell you about to what extent the Fed policy, the monetary policy, has started to take hold?
It's certainly starting to kick in, but actually when we look at earnings, just in the past week, earnings have been revised up for 2024 from 246 to 247. So the economy's holding in there. We obviously know the Atlanta GDP now is pointing to positive things for Q3. So it's kind of this perfect balance. Operating margins are up 1% from last year. No one expect that from 10.9% to 11.9%. So I think if we have a little softness in the labor market, which we're seeing, the quit rates are starting to decline. The job openings, as we saw with the JOLTS yesterday, are starting to soften. That creates an environment where you're not going to have the wage price spiral, where you're not going to see this accelerating wage inflation. And that's going to give a lot of comfort to the Fed. That's going to keep their pedal off the metal, let them keep rates elevated like we saw in the late 90s, and have this kind of perfect situation where the economy is slowing a little bit, but the Fed is done tightening, and then companies can start to perform. And I think there'll be a lot of rotation under the surface. So for those expecting the Magnificent Seven to have a monster second half like they had the first half, I think they're going to be a little surprised.
Tom, what do you think that upside looks like when we talk about where we are right now? The S&P is still above 4,400, adding to some of those gains today, up about 0.5%. What does that upside look like then between now and the end of the year?
I think you're going to see chop, but I think all of these dips are going to be bought. Just like you saw, we had a 4% dip in August. Maybe you have another 3% or 2% dip through the fall. But if you look at the S&P 500 was up about 20% through July. The Barclays Hedge Fund Index was only up 6%. So there's a lot of people that have to play catch up. Cash levels are coming down, but they're still elevated. Risk levels for institutional managers are still near the COVID low levels in the great financial crisis. So they haven't believed it, and they're behind their benchmarks. So they're going to desperately look for areas to buy, but they're not going to chase those stocks that are up 30 and 50 and 70% like the Magnificent Seven. They're going to be looking for stocks that haven't yet participated, where they can still find value and get their performance into the end of the year.
And on that note, Tom, you've laid out in your notes, dips must be bought, in quotes. What specifically are you looking at?
Well, we want to find kind of those areas that have been impacted by interest rates, that have dramatically been impacted by interest rates. I think one thing that's kind of the obvious thing that no one's really paying attention to is Treasury notes. And I know you did start the segment with that. But what you see is large speculators and traders are the most short the 10-year Treasury than they have been since 2018. That was the last time we had a major low in the 10-year Treasury, a major high in yields. Also, commercial hedgers, which are always early and always right, have been buying the 10-year Treasury like crazy. That usually happens near inflection points. So I think one interesting trade that could be a surprise into year end after this $1 trillion of supply is finished coming on the market, which has been coming on over the last few weeks, is that the 10-year Treasury actually gets bid and yields compress. You're also going to see a tremendous amount of pension demand into year end, that they can come in and lock in their long-term liabilities at 4, 4.5, 4.25, and they're going to want to do that for the long term.
Tom, how should investors be thinking about portfolio weight, right? Because we always thought about it with 60-40 when it comes to equities versus fixed income. We're seeing this opportunity, you're seeing opportunity in treasuries. Does that still make sense?
It depends. So usually when you think about 60-40, you're thinking about corporate bonds as some part of the mix. The other thing I want to be distinct about is that T-bills are overweight. So managers are still dramatically overweight treasuries, but on the short end of the curve getting 5%. Okay. They're not on the intermediate to long term. So now is the opportunity to increase duration if you've been on the short end of the curve. I think the short end of the curve is extremely crowded. And to then move to those equities that haven't yet participated, some of the value stocks that are going to participate in the second half of the year that haven't really taken off in the first half of the year.
Tom, one of the big stories we've been following is, of course, the slowdown that we have seen in China. There is not at the pace that we have seen in past years, and we've seen Chinese listed, ADRs move in conjunction with some of that data that's been coming out. How do you view that trade right now?
All right, well, this is interesting. The two most crowded trades are long tech, and we think the Magnificent Seven will be fine, but they're going to underperform into the second half of the year. But short China is the second most crowded trade for institutional investors. And we think the worse the headlines get, the more bullish it becomes, because the Chinese government has been acting at the margins to stimulate, cutting mortgage rates we saw, cutting short rates for banks, et cetera. But they haven't done the big bazooka. They haven't put money in consumers' pockets. And everyone, that they're going to be forced to do that before the end of the year, and that's going to be a monster boon. The other thing, if you look at, the headlines have been bad, but if you look at China internet stocks, Alibaba, Pinduoduo, Tencent, their earnings have been off the charts. EBITDA was up in aggregate 30% year on year. Revenues were up about 7%. So I think once the Fed is winding down the tightening cycle, as we talked about earlier in the segment, you're going to see rates compress, you're going to see the dollar weaken, you're going to see flows into emerging markets, and then you're going to get the China stimulus on top of that. It's a trade that no one wants to talk about right now, but I think as you look 12 months out, you're going to be extremely happy that you participated in emerging markets for the next 12, 18, 24 months.
All right, Tom Hayes, we got to leave it there. Thanks so much for joining here this afternoon.
Hurricane Idalia making landfall in Florida as a Category 3 storm. The storm now churning through the southeast as a Category 1 hurricane. In Florida, streets from Tampa to Tallahassee at the 200-mile stretch there are facing floodwaters, and power has been knocked out for 400,000 customers across Florida and Georgia. Joining us now is Tallahassee Mayor John Daly. Mayor, it's good to talk to you today. Just give me an update here on what you are seeing on the ground right now.
Well, first of all, thanks for having me on. I certainly do appreciate it. We are in full recovery mode. As soon as the storm moved out, Of course, we sent our first responders out first and foremost to check on the citizens to make sure everyone is safe and healthy and survived the storm event itself. And then we immediately sent our utility crews out. So before the storm, we planned in advance and we called in our mutual aid agreements from all over the United States of America. We tripled the size of our electric workforce, knowing that we were going to have damage to our electric infrastructure. And sure enough, we did. And so as soon as possible, they are out there and they are returning power to the city of Tallahassee. About 1/3 of our customer base lost power. And the great men and women of Tallahassee and our mutual aid agreements, they are out there right now trying to put the power back together.
Mayor, thanks so much for taking the time. Certainly seems like there is still, though, a lot of damage when you talk about the destruction that you are seeing, the number of downed trees within the area. What's the extent of that damage relative to what you were bracing for heading into this storm?
Well, I do think that we got a little lucky. When at 6:30 this morning, we're sitting in the EOC. We thought that we had a Category 5 hurricane, and as predicted by the National Weather Service, was going to be the largest and strongest storm to hit the Big Bend area of Florida, including Tallahassee. And while that is still true for the rest of the Big Bend, Tallahassee did not take the brunt. Once it hit landfall, as we all know now, it went due east. And so we got caught up in high winds, but we did not get caught up in particular in the Category 1 hurricane winds. But as a result, we do have a lot of trees down. We do have a lot of damage to our electric infrastructure. Tallahassee is known as a tree city. 55% of our community is under a tree canopy. And as you can imagine, high winds, power lines, and trees do not mix. So as a result, we did have a lot of damage, and our crews are out there cleaning it up right now, cleaning out the streets, restoring the power. And I'm real honored and proud to work with them. They're great people.
Yeah, Mayor, it feels like we've all gotten to know the Big Bend region over the last several days as we followed this hurricane and its path. You know, give us a sense of the extent of this storm. I mean, when you think about the weather patterns in your region, yes, it didn't land at the scale that we thought it would, at the intensity that we thought it would. But I mean, how significant is this in the grand scheme of things in a state that has seen, quite frankly, a lot of hurricanes?
Well, it's significant and it impacts different communities in different ways. For instance, city of Tallahassee, we're an inland community. So while we did not necessarily have the concerns of the storm surge directly impacting the city of Tallahassee, of course, we were concerned with flooding in low-lying areas. However, I talked to my colleagues, mayors of the coastal communities, and they're dealing with a whole nother set of challenges. And, we send our thoughts and prayers to their communities as well as they're dealing with the rising waters and how it's impacting their community. For us, it's a wind event, and we are more impacted by high winds and how it impacts our infrastructure. But you're absolutely correct. It is a high intensity impact to the state of Florida, to the Gulf Coast. I think it still stands as predicted by the National Weather Service yesterday as being the largest storm in the history of the Big Bend area. Again, Tallahassee was not directly hit. We got lucky, but it has caused a lot of damage across the area.
Mayor, what's your message to residents right now?
That's a great question. So if you walk outside right now, it's actually a beautiful afternoon in Tallahassee, but we are still highly encouraging all the residents, stay inside, check on your friends and family, check on your neighbors, but we still have a lot of work to do. We have a lot of roads that are still blocked. We got trees down everywhere. We got power lines down everywhere. We need to make sure that we have a safe community in an environment that allows our utility workers to go out and do their job. Let the professionals hook the electricity back up and let's give them the day. Let's don't get out on the road and check out the rest of the community. Shelter at home still for the rest of the afternoon and evening and let the professionals do their job.
And Mayor, I realize you're still in assessment mode right now. You've got some busy days ahead of you, but talk to me about how you're thinking about moving forward beyond this in terms of the recovery, the next steps, the most immediate concerns beyond the power outages you've already hit on.
Well, we always do a complete assessment. I'm real proud of the leadership of our city manager, Reese Goad, and the teams. We are the largest utility provider in the region. We're a municipality of 200,000, 300,000, including the unincorporated area with a population of 70,000 on our college campuses. We are the largest utility provider. We planned well in advance. Our stormwater system worked, our water system worked, and we've had some damages to our electrical system. So we have work to do. Now, after every storm, we do a post-storm assessment. What worked? What didn't work? What do we need to work on? How do we change the plans? Because truth be told, as you know, this is the last week of August. We are in the height of hurricane season. And unfortunately, those of us that live in Florida and along the Gulf Coast know very well we could be right back here a week from now, 2 weeks from now, a month from now. We can't predict what Mother Nature is going to do. So it's important that we learn from every storm event that comes through. We celebrate our victories and what worked, and we make sure that we double down and continue to do that. But if we need to make modifications and changes to the plan, we'll do so, because we know that there will be another storm event heading our way in not too distant future.
Mayor Daley, we know you have long days, weeks potentially ahead of you. Thanks so much for taking the time. We wish you all the best.
Thank you.
We are just getting started here on Yahoo Finance Live. Coming up, crypto's big victory. Grayscale is one step closer to getting approval for its spot Bitcoin ETF. What could this mean for the crypto community? That's coming up. And our $1 million listings, the new norm for the middle class. We will take a closer look at the housing market's hefty price tag. And right after the break, Yahoo Finance's Brian Sazi speaking with the CEO of Hewlett-Packard Enterprise, Antonio Neri, about the company's third quarter earnings beat. We got that and much more when we return.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Hewlett-Packard Enterprise out with better than expected results, in large part because of demand for all things AI. Let's get right to the man of the hour here, HPE CEO Antonio Neri. Antonio, always great to get some time with you here. So let's start on the macroeconomy and the impact to your business. Is the economy in the U.S. and around the world starting to cooperate with a company like yours?
Well, I think we continue to navigate some uncertainty in the macroeconomic environment, but I will say IT continue to be a top priority for customers because they need IT to operate in this digital world. And what we saw in the Q3 earnings is that we saw sequential order improvements. The demand improved across all our key business segments, but obviously the star of the demand, I will say, the leader was AI, where we saw a wave of acceleration, also coupled with our HP GreenLake cloud platform. So we have a unique portfolio, and we're taking advantage of the diversified portfolio we have.
Lots to unpack in that AI part of your business. I will touch on that, I promise. But on the enterprise spending, when you talk to large customers, are they still making tough choices? Are they loosening up their budgets? Has that changed at all compared to 3 months ago?
No, I think it continues to be the same, right? So we see areas of the portfolio where the sales cycles continue to be elongated. So they're taking the time, perhaps more approvals in the process. And we see areas where are really becoming stronger. So, for example, everything related to connectivity, connected people, devices, and things to accelerate that data-first modernization, digital transformation is core, because they need to be more effective and efficient in how they conduct the business. And obviously, we saw a significant uptake in AI because everybody wants to adopt AI into the business model. So depending on the area of the portfolio, in some areas, elongated cycles, some other areas, a little bit of more frothy, if you will, but ultimately, all in the right direction because IT will continue to grow on a long period of time.
For the investors on our platform, Antonio, that may not be totally familiar with your business. You saw a large uptick in sales in the intelligent edge business, up 50%. Does that reflect demand for AI-related services and products?
Well, remember our portfolio. So we have a cloud platform, which call it HP GreenLake, is a true hybrid cloud platform where we give customers the ability to deploy hybrid IT across the entire estate, whether it's to put workloads and data in the public cloud or on the premises in a co-location or at the edge, even more now. And so that's our HP GreenLake platform. That platform now has under the umbrella $12 billion in cumulative total contract value, and 5 years ago was zero. And then ultimately, we continue to drive that business through the software and services mix, which improves sequentially, again, 2 percentage points, which drive obviously higher margins. But that business grew 122% year over year. And underneath that, Brian, we have 3 core businesses. One is the edge, which is obviously the connectivity business, the networking business. That performed exceptionally well. It's the 5th consecutive quarter of record-breaking revenue and profit. Now that Intelligent Edge business represents 20% of the total company revenue and almost half of the company profit. 2 years ago, it was less than 10% and less than 15%. So massive improvement there is the new core, I would call it, of the company. Hybrid cloud obviously includes compute and storage, which tends to be more cyclical. but at the same time, we have a lot of infrastructure as a service and SaaS, and then obviously AI. And so when I think about our results, clearly we have transformed the portfolio. We continue to make shift to higher growth, higher gross margin areas. And now we see AI as a turbocharge in the future. And we embed AI in everything we do. But as I think about AI, think about how people train data, tune models to their data in a private, secure, responsible way. And then obviously how we use that in our production models, what we refer as AI inference models.
Within your backlog figure, is there a number to parse out in terms of total AI demand? Do you have an idea on how much demand you are building in your book of business because of the AI solutions that you have?
Well, it has grown triple digits, no question. And we exit Q3 with the largest ever order book in our HPC and AI segment. And that was symbiotic with the HP GreenLake because HP GreenLake offer all of that as a service. So it's an accelerator of HP GreenLake, but also AI needs HP GreenLake to offer in a pay-as-you-go model. And then in the rest of the business, we embed AI in our SaaS offerings. Everything related to networking, compute, and storage has now more and more SaaS attached because that software delivers the experience that the customers need through the infrastructure. And that has a component of AI now embedded and will continue to grow as we go forward.
You mentioned on the earnings call, Antonio, NVIDIA. Do you work with them? Do you get chips from them?
Absolutely.
Can you get the chips you need from a company like that? Because all we hear from the outside looking in is that prices for these H100 chips have gone through the moon, and there are essentially only a couple companies getting the chips they need.
Not really. I mean, we work extremely well with Jensen and his team. It's a fabulous team. We have an amazing relationship. In fact, I just spent more than a half a day with him and the team just 10 days ago in his headquarters in the Silicon Valley. We talk about how we grow together, how we bring both sets of assets in a way that democratizes AI for everyone. So I'm very bullish about that. And we have unique value that we bring to the table. Because let's be clear, HPE has been in the AI space for a decade. We have done AI for unique customers in academia, government, and very, very large enterprises that built specific, built-for-purpose systems like supercomputers. Remember, we have deployed the largest supercomputers on the planet, and we have more to come as we look into 2024. And so it's a very symbiotic relationship. Now, our demand had outpaced any supply availability, including for NVIDIA. But what we booked in Q3, only a very small fraction actually shipped. And remember, the revenue recognition that business has additional conditions, which is not the type of shipment, but also the time of receiving and acceptance of these massive systems we deploy.
As someone that has been involved in tech for some time, Antonio, does this feel like a special time in the industry to you? And
Yeah.
what do you think's on tap? What's the biggest thing next year you think we'll all be talking about?
Well, I think about the AI as one of the most important, if not the most important inflection point, at least in my lifetime. I compare this to what I call the Web 1.0 or the mobile shift that we saw. And obviously, it has the potential to disrupt every industry, but also address some of the biggest societal challenges we all live. So it's not just for the context of business, but also in the context of the challenges we live. Think about it. How we accelerate, the reduction of their carbon footprint. When you think about using AI and supercomputer technologies to innovate new technologies to reduce the carbon footprint, we see that every day in climate research and also in things like modeling simulation. When I think about finding cures for diseases like dementia, Alzheimer, and think about COVID, the reason why we got to a vaccine in 9 months is because we had accelerated computing that allowed us to accelerate the research for these compounds that ultimately address these viruses. There is so many use cases out there. The key here is to do it in a sustainable, responsible way. And sustainability is going to be essential because this type of accelerated compute consume a lot of power. And Hewlett-Packard Enterprise is uniquely positioned to deploy the most sustainable supercomputers on the planet because we have that expertise. So we believe we're on the cusp of some revolution. What comes next, I don't know exactly, but I will say, obviously, we see quantum computing emerging along the way, neural computing as well. So it's just a remarkable time to be in this industry. And I have a lot of fun with my team, tackling the challenges and the opportunities.
And we've had a lot of fun following all these things that you guys continue to work on over there at HP. Antonio Neri, always great to get some time with you. We'll talk to you soon. We appreciate it.
Thank you, Brian.
And we will be right back on Yahoo Finance with a lot more.
It's back to school season, and we are looking at what this means for the stock market. Jared Blickery is here with a closer look of what we could expect in the coming weeks, Jared.
Yes, back to school, back to the charts here. This is the S&P 500 year to date, within spitting distance of its high that it reached at the end of July, early August here. But I want to talk about what usually happens in September and the other months into the end of year. So here, this goes back to 1960, and this is S&P 500 performance by month. So if you invested starting in 1960 only in the month of September with $1,000, your investment would now be equal to $600, or that's a 40% drop. October is still a win here, but it significantly has quite a bit of volatility in it. And just thinking about September in general, no matter if you go back all the way to 1950 or only 20 years ago, you're going to find that no matter how you slice and dice it, September does tend to be negative. Here we go, 1950 to 2021, that's this purple line right here, and the other ones are cutting it just a little bit differently, but you can see we rise a little bit into the middle of the month, and then we fall off towards the end. But I did point out something that's pretty interesting and a little bit different this year. We had a really strong year up until July, and then we fell off in August. So I went back and I looked at what happens when we have this exact configuration or a similar one. That is, the S&P 500 is up 10% as of the end of July, but August is negative. This has happened 11 times going back to about 1960 there. And you can see for September, this is what happens in the month of September, 2.3% average return after that, 82% positive. In October, also green. November, December, even if you can't see the numbers here, I just want you to see that the results are green. Now, we do only have 64% positive in the month of October. That is prime time crash month, so is September. But what I found in screening for these years, when we are up big early and then we flag off in August, we don't have any crashes in these years. It could be simply cherry picking data. It could be a little bit of optimization, but history is telling us that we don't have to worry about a crash as much this year. So pretty interesting on that front. And I could just take it back to the market in general. We're looking at a market, as I said, S&P 500 within spitting distance of its highs there in July. We have a lot on the calendar. And when I talk about seasonality, I guess I have to end with a caveat. That is, these are only historical tendencies. This can account for up to 1/3 of price action. But as we know, the Federal Reserve, what happens with CPI, PCE, non-farm payrolls this Friday, any of that can override this.
So we'll see. Seems like it's a toss-up then, fair to say. All right,
Yes.
Jared, thanks.
Well, Bitcoin and other cryptocurrencies taking a breather today, just one day after a big rally fueled by the court ruling tied to Grayscale's ETF. Our next guest, not surprised by those declines since he's bearish over the next 12 months. Joining us now is Terrence Yang, Bond Bitcoin Managing Director. Terrence, it's good to talk to you. I'm curious to get your reaction to the court ruling that came down yesterday, because you've said for a while that there needs to be a bit of cleaning up that happens in the industry. The adults are starting to come in. What does this court ruling mean in terms of implications for crypto assets?
Yeah, so this is obviously bullish for Bitcoin ETF approvals, because the court basically said what? That you cannot rule differently for Bitcoin spot ETFs and Bitcoin futures ETFs, which are already approved. There's no real distinction. 99.9% of the price difference or of the prices correlate with each other. So they kind of trade together, the Bitcoin spot price and the Bitcoin futures price, and the SEC did not have a good answer for that. I'm still bearish, but I'm changing my timeline from 12 months to maybe 6 to 9 months. And then I'm super bullish because I do think, as I've said before on elsewhere, that Bitcoin spot ETFs will be approved in the United States. Why? Because they are cleaning up crypto. Yesterday, one thing that's very interesting that is way underreported, I feel, and undertweeted about, is the fact that the SEC, on the same day that they lost against Grayscale, in their Binance case, they filed about 37 sealed documents, which is extremely unusual, suggesting that maybe they have witnesses they don't want tampered with, or that the DOJ might be going after Binance, and there's information they want the judge to see how serious things are against Binance, but not want the public to see.
So what do you think that then means for the price of crypto, the price of Bitcoin then, at least in the near term? Certainly sounds like we could see a lot of volatility if that is in fact the case.
There will be some volatility as the market digests, and I believe comes around to my view that short term, there's too much hopium. There's too many crypto bulls and Bitcoin bulls who think that the ETF will be approved, ASAP or in the next several weeks. I'm not sure we're going to see a launch of any Bitcoin. I don't think we'll see a launch of any spot Bitcoin ETF before year end. And I'm happy to bet people on this. I've been kind of goading some of the hopium bros on Twitter to bet against me.
Even with the cleanup that's happening within the space, you said that there's still a lot of price manipulation that's happening specifically on Bitcoin. We're seeing it trading above that $27,000 handle. What is the real value, you think, if the manipulation's still happening?
So I think Bitcoin, the real value is it's way undervalued. This is the best asymmetric upside asset with asymmetric upside I've ever seen in my life. And I've been in finance many years. But short term, who knows? Because until the wash trading, price manipulation, and fraud is completely cleaned up, I do feel like if you look at the trading volumes, they've gone down in Bitcoin, maybe because of US and Chinese authorities going after some of these Chinese exchanges like Binance, like Huobi. And the threat of that has made them kind of not want to be as aggressive, I think, in their wash trading. So maybe the current volume is about right when you strip out the bump up in trading volume due to this recent Grayscale decision. But for some time, we've been seeing a pretty significant decline in trading volume.
Terrence, the interest that we've seen from BlackRock, from Fidelity, just to name a few, on a spot Bitcoin ETF here potentially for the future, how big of a catalyst is that going to be just in terms of wider adoption and getting more people to eventually potentially trust Bitcoin?
Sure. Once they launch, especially those two, plus Invesco, which is the manager for QQQ, the very popular tech ETF. Once those three launch, or any of those three launch, it will be a massive bullish sign where a flood of money should come into Bitcoin and Bitcoin ETFs. Why? Because those three are three of the most respected traditional finance or TradFi companies in the world. They really know ETFs. They really know finance. They're respected by institutions and high net worth and other folks as well. So once they are actually launching and offering Bitcoin ETFs, I think a flood of cash will come in. Very different from gold ETFs. Why? Because gold was around for thousands of years, accepted across all cultures as valuable. By the time the gold ETF came about, it was like, okay, this is great. There was a flood of cash that rushed into gold because of gold ETFs. But I think with Bitcoin, it's going to be like 10x bigger, if not much more, because Bitcoin is a teenager. It's considered a scam by some of the people I respect the most in my life, family members, extremely accomplished law school classmates. They don't get Bitcoin, and I think that's going to change within about a year.
So what's the upside you see? I mean, short to medium term, you said you've moved up your timeline, 6 to 9 months. Where's that price going to be 6 to 9 months from now?
Once they launch, so this is my guess, right? 6 to 9 months is based on my guess that the Bitcoin trading volume continues to stay down, so there's not a lot of wash trading, fraud, and price manipulation, and the DOJ and Chinese authorities continue their progress or seeming progress against some of these Chinese exchanges. I hate to say it, but yeah, if I had to pick a number, it could easily go way past the 69,000 all-time high for Bitcoin in about 12 months or so.
12 months. That's a pretty bullish call. We'll have to have you back on, Terrence, to see where it goes.
Great to see you again.
Terrence Yang, Bitcoin Managing Director. Good to talk to you today.
Thank you. Bye.
Up next, the market share of million-dollar homes is on the rise in many cities across the U.S. We're going to tell you why after the break. We'll be right back. The share of million-dollar homes is up across the country, and it's leaving home buyers with very few options as prices near all-time highs. Here to explain is Yahoo Finance's Rebecca Chen. Rebecca, we're talking about million-dollar listings here. It is scary how desensitized you get, right? When you are in a market like LA, California broadly, New York. I mean, $1 million feels like the starting point right now.
That's right, Akiko. So what we're seeing from Redfin is that right now in America, about 8.6% of all homes are over $1 million. And that is already an increase from just a couple months ago in February when that percentage was just 7.3%. And in fact, like you said, in California, two cities, San Francisco and San Jose, actually have more $1 million homes or homes above $1 million than less than $1 million. In fact, in San Jose, we saw that the median price home is sitting at $1.8 million right now. And San Francisco, even though it's a little bit less, but still, the median price home is sitting at $1.34 million. And we also dig a little bit into some housing transactions in the past 6 months. And we saw that in San Francisco, in the last 6 months, there were nearly 900 units of homes that sold above $1 million. And, you know, these are homes there are even homes that are selling into the 8 figures. But as for homes that are under $1 million, only 100 of them were at that price.
So, Rebecca,
and so some of the experts we talked to actually said that in these expensive cities, the $1 million homes is not really a symbol of luxury, but really a necessity.
So, Rebecca, where does that leave potential home buyers there? Because it doesn't sound like they have a lot of options with over 8% of homes selling for over $1 million or on the market for over $1 million.
That's right. So another thing that we looked into was we were looking at the active Redfin listings. We pulled up a city. So we looked at San Diego. And we really saw that in San Diego, the buyers is not having much choices, very, very limited inventory at a reasonable price. So when we filter a Redfin listing for homes under $1 million, we saw that less than half of the listings were at that criteria. And in fact, if you are a new home buyer and you're looking for that starter home, you know, a single family, 3-bedroom under $3 million, there were only about 60 units in the city of San Diego with those criteria. So what it's really saying is that there are really limited choices for people out there. So we're definitely seeing that in these cities, buyers are not having many options. Right now, it seems like $1 million home is a middle-class resident property for these cities.
Yeah, you know, there's an affordability problem when you're talking about a starter home or fixer-upper above $1 million. Rebecca Chen, thanks so much for that.
Well, CNN has a new CEO, Warner Brothers Discovery, appointing Mark Thompson as chief executive of the cable news network. He previously served as director general of the BBC, as well as CEO of the New York Times. Thompson coming to CNN at a critical time for the media industry as cord cutting accelerates and traditional TV struggles to keep up. Here to discuss this and much more, we want to bring in Michael Wolff, CEO of Activate. Michael, it's great to see you here. So let's start with CNN's new appointment for their CEO, Mark Thompson. Is he the best candidate for this job, and why?
He comes with an incredible pedigree and an incredible track record. So between understanding television from the BBC and managing a massive news organization to what he accomplished as the CEO of the New York Times Company, especially in terms of building a subscription base and continuing to expand their users. Now, here's what's happening. Ironically, up until recently, CNN was the largest news website, roughly about 400 million unique visitors. And just recently, the New York Times overtook it just by a couple million. And so I think we're going to see it's going to continue to, of course, be a race between those two as well as others, MSNBC and Fox News and even the New York Post. And of course, Yahoo Finance.
Yeah, we appreciate you adding that Yahoo Finance in there, Michael. You know, this, of course, comes at a time when you think about, especially in the streaming space, there's this real divide that's happening between linear and digital. You're talking about CNN, which we tend to think more as linear. You know, Bob Iger over at Disney is looking at options for ESPN and what to do there. I mean, what kind of shakedown you think is coming when you think about brands like Warner Brothers Discovery as well as Disney in terms of linear and digital?
Yeah, so part of what we're seeing and what really is driving this urge to merge among these companies is the need to really position themselves in this world where increasingly we have fewer and fewer subscribers. We now have 70 million people and 70 million homes in the US that are subscribing to cable, and we expect it, at Activate, we expect it to go down into roughly 60 in the next couple of years. And at the same time, these streaming services they're big cash drains. They're very deep expenses for the next couple of years. And it's no different how long it took for each of these companies to make their cable networks profitable. So cable networks have been the golden goose. Suddenly we have something new coming on in streaming. They're all trying to position themselves for this future, this direct-to-consumer future. And I think that, by the way, despite the fact that the CEOs of these companies say that they're going to cut back on their spending on programming, we think and we see and we forecast that their expenses and their investments in programming are going to continue to be at these levels and, in fact, continue to increase.
Michael, that of course then brings up the question of pricing when it comes to the streaming side of the business, right? Because we know Bob Iger time and time again has reiterated the fact that he is focusing on profitability for their streaming division, and Disney recently raising prices following a number of their competitors who have done so very recently. How do these media companies, how are they thinking about price hikes and balancing that with making sure that they don't see a massive increase in churn?
Well, I mean, you really hit the nail on the head, which is they're trying to strike that right balance. And so the fact that we've seen some decline in Netflix in the last quarter, really some of that reflects a couple of things. One is price increase, but also the eliminating password sharing. And so you would have thought that would have increased the number of subscribers. So I think that what's the bigger issue is not whether those price can be sustained, but also they're having a lot of churn. It's very easy to watch a set of shows on Disney Plus and then drop it and go to Max and watch it. So we as a firm, we forecast that by 2026, the average subscriber will have 6 streaming services. They're just not going to be the same 6. They're going to churn in and out among these services. Price might not be the reason that determines it. It's just more about the availability of programming on those networks and streaming services.
Yeah, I'm surprised at that number, Michael, at 6, because it feels like, I was thinking back to the conversation when streaming first launched. It was about the optionality, and you don't have to pay for these massive cable bundles. And it feels like cable is cheaper when you consider 6 different subscriptions you have to pay for. It feels like increasingly sports could be one that could make a lot of these places very sticky, because it is one that comes up on a weekly basis, maybe not as much churn. I mean, how do you think these streaming services are positioning themselves on sports with that very idea in mind, that there is a limit to how many streaming services viewers want to subscribe to?
Yeah, I mean, precisely. What we're going to see is that, and already seeing, is that between Apple and Peacock and Amazon and others, they're already getting streaming rights for sports. They're not getting all of it. So you've got Amazon with Thursday night football, as well as they're going to do one preseason game and a special game on Black Friday. And we're going to see that all the way through to Apple really locking up Major League Soccer for the next years. So we're going to see those games go back and forth. And yes, it's going to be another reason for people to watch, but you can't get all of the games in the same place. So you're going to have to subscribe to different services, and you're going to have to keep watching them on television in order, if you're really an avid super sports fan.
Michael, we're talking about the media landscape right now. We also have to talk about the strike that's going on, right? Because when we talk about the pressure that so many of these media giants are facing, it almost seems like from all angles, obviously the strike is another pressure point here for these companies, for the studios, for the streamers. How much more challenging is the next several months going to be the longer that this strike goes on for? And I guess who is best positioned given the circumstances we're in today?
Yeah, I'm hopeful that the strike won't last forever. Part of it is that the time is really inopportune. The profit pools for programming production are drying up. Even though there's a whole set of new shows, they're really at much lower cost levels. And so I'm not sure there's going to be a lot of profit left to distribute. And the other reason why it's in an opportune time is because the revenue streams for these shows aren't necessarily settled. And so the actors and the writers may find themselves in a position where they put their earnings more at risk than less, as they want to have a piece of the profits, and the profits may not be there. Interestingly, the last time that one of these strikes took place, last time was well over 10 years ago, and at that point they were arguing about who got residuals from DVD rights. So the world has changed, and yes, the relationships with writers and actors and artists are going to change, but this is a tough time to be making those demands.
And it is a tough time, certainly a tough time for both sides right now. All right, Michael, always great to have you. Thanks so much for joining.
Great to be here.
We'll be right back. And that's the closing bell on Wall Street, checking in on where we are closing the day. All three of the major averages ending in the green. You're looking at the S&P above 4,500, up now for 4 days in a row. The Dow up just about 38 points. The Nasdaq up about 0.5%. Investors sifting through a number of econ data prints that were out this morning before the bell, showing slowing growth, and looks like investors actually taking that as good news, and maybe that means that the Fed is going to back off on future rate hikes. But again, all three of the major averages closing today to the upside. Let's check in on some of the top trending tickers of the day. Shares of Visa and MasterCard both closing to the upside on reports that the two companies are planning to increase fees that businesses pay when they accept customers' credit cards. Now, the increases are scheduled to start in October for Visa's online transactions and MasterCard's new pre-authorization fee for credit card purchases. Akiko, obviously, this is bad news for merchants. We know merchants are likely going to fight this. They are already facing a pretty steady climb in the amount that they are paying in terms of fees for these credit card companies. But it does mean something for the consumers at the end of the day, because the merchants are likely to pass along those prices in some capacity to consumers through higher prices for their products.
Yeah, I mean, that is the big concern. I mean, it's worth running through some of the numbers in terms of where the fees stand right now. U.S. merchants paid an estimated $93 billion in Visa and MasterCard fees last year. You talk about this additional hike that we're talking about today, an additional $502 million annually in fees. And really it does come down to businesses saying, look, this is just not the time to be doing it. That's the concern, especially with the higher costs they've had to deal with. And then, of course, the concern on the other end is if they're not able to shoulder some of those additional costs, and how much of that is going to get passed down to consumers. So we'll have to be watching when those hikes take effect in October as well as April. Well, shares of PC-making giant HP Inc. in the red today as slowing demand for computers led to a full-year profit warning. HP now sees full-year adjusted earnings of $3.23 to $3.25 a share. That's down from $3.30 to $3.50 previously. The stock getting hit today, down more than 6%. It feels like, Shauna, there's kind of two schools of thought here. When you think about analysts that are weighing in, you've got Evercore ISI saying, this is sort of the short-term pain that we're seeing, but long-term, HP's margins are holding up at the top end of its product range. They've maintained a price target of $33 a share. But then you've got Citi that says, like, even if the PC demand, which of course has been quite weak, even if those turn around, the print headwinds are still likely to really pressure HP moving forward.
Yeah, also Morgan Stanley pointing to those print headwinds, the decline that we saw here in the most recent quarter, and taking a look at what those sales looked like for HP. Print declines for sales off about 7% to $4.3 billion. And the argument here is that the declining sales, well, that could actually limit future growth. And when we talk about this turnaround story, clearly not taking place in the timeline that HP had initially anticipated. So the company really seeing the fact that others are putting off spending amid job cuts, amid the broader pullback in the economy. They also cited a weakness out of China as another headwind facing HP. So I think there's lots of questions just about what this recovery is going to look like and potentially how much longer it could take relative to what executives had been hoping for. And they were hoping for, obviously, that it would be taking place right now and we'd see it pick up in the second half of the year. All right, let's also take a look at shares of NVIDIA closing the day in the green, hitting an all-time high, now up over 230% on the year, closing the day up just about 1%. Now, this coming after the company's second quarter earnings recently blowing past already sky-high expectations. The AI hype train continuing to push the stock higher. And Akiko, when you take a look at the street's reaction to the results and what we've seen play out over the last week or so, Wall Street continuing to get more bullish on NVIDIA. The average analyst price target now at $644 a share.
That is incredible when you consider that run. I mean, a number we like to say a lot, Shauna, is NVIDIA has a market share of 85 to 90% when it comes to AI chips. But our tech editor, Dan Halley, has an interesting piece out today that essentially says, look, there's a first mover advantage, but this isn't going to last at these levels for long for NVIDIA, largely because their competitors, especially AMD as well as Intel, are working on their own offerings. His piece seems to suggest that they could really make big inroads, particularly based on what NVIDIA has right now. But the stock still trading at, what was that for? Can we bring that up again? 690, was that the call? I mean, that's the street high, right? Still got a long way to go at $492 a share. Well, over the next few weeks, Yahoo Finance is taking a closer look at the Magnificent Seven and what investors should keep in mind with the biggest names in tech. Today, the focus turns to Tesla. It's up over 100% on the year. The EV maker has shown no signs of slowing down, but as friend of the program, Steve Sosnick asks, should we be more concerned about Tesla's present and near term rather than its long-term future? Let's bring in Yahoo Finance's Ali Garfinkel for more on what investors should be focused on for Tesla. Ali.
Akiko, Tesla has never been just about Tesla, right? Tesla has been about futurism. It's been about fear of climate change. And it's been about, well, faith. Steve Sosnick and I were actually talking, and he literally called it a faith-based stock. Now, that being said, I want to push that faith aside. I even want to push Elon Musk aside for a moment and talk about some of the fundamentals we're really seeing in Tesla, especially when it comes to the near term. Now, some things to think about include increasing competition. Tesla's competition is really gaining traction, right? You, of course, have competition in the US, think GM or Ford, which both saw EV sales growth this year. But But I want to think even bigger than that. You out there, I want you to think bigger, because think about Chinese car company BYD, which surpassed Tesla this year as the top-selling EV in the world. Now, we may not have heard of it here in the US, but that's because their growth is coming from so many other places. They're targeting South America, they're targeting Africa, they're targeting the Middle East. BYD has also reportedly set its sights on India, already has an assembly plant there, and we know that's an area Tesla is interested in. The other thing to consider here, for the near term at least, are Cybertruck concerns. Now, if it feels like we've been talking about the Cybertruck for forever, it's because it's been a couple of years. The Cybertruck was announced in 2019, but it still fundamentally is a concept car. Production has been pushed back 2 years from its original date, and there are still even problems. Musk himself reportedly is concerned about the design and execution. Now, imagine the Cybertruck with me for a moment. You've got those misaligned doors, you have those uneven surfaces, and that really can become an engineering nightmare. So there are talks even of a possible redesign of this car that has already been in production for so long. The clock fundamentally, I would say, on the Cybertruck is ticking. Because remember, again, nothing at Tesla is ever exactly what it seems. The Cybertruck is sure about the truck. It's also about Tesla really grabbing its piece of the pickup truck market. But even more so, it's about Tesla doing something it hasn't done in a while, which is show us something new.
So what does it mean for Tesla in the long term, Ali?
It's a good question, Akiko, because there's a lot of on one hand and on the other handing I'm about to do here. Because on one hand, there is some delivery growth from Tesla, right? Last quarter over quarter, 10% delivery growth. And analysts say that that's a win, but it also ties back to discounting, for example. That's where a lot of that growth is coming from. And remember, Tesla has scaled incredibly quickly, but they've also done a lot of recalls to that effect, right? They recalled 4 million cars since January 2022. On one hand, they have this maturing supercharger network, this battery operation that really is going to provide some longevity, but also they really don't have a secondary market that makes repairs easier. So I'd say in the end, Tesla isn't in a bad place exactly. It's definitely in a weird one, though. I'd say it has both the traits of this maturing company and this growing company. And it's going to take some time for that transition to really iron out.
Ali Garfinkel with today's playbook for the Magnificent Seven. Appreciate that. Thanks so much.
All right, we have some breaking news. Salesforce out with its second quarter fiscal year 2024 results, and let's break down the numbers. It's actually a pretty strong report here from Salesforce, digging into what we're seeing revenue and EPS beating on here. So a beat on both the top and bottom lines. Their guidance also coming in better than expected for the third quarter. They also raised their full year outlook for sales and earnings. So Salesforce seeing third quarter sales of $8.7 billion to $8.72 billion. The estimate there was for $8.66 billion. When you take a look at what they're expecting for the full year, they raised their full year sales outlook $34.7 billion to $34.8 billion. Also, they raised their full year earnings outlook as well. The company also raising its full year operating margin. There's a theme here. Raising the full year operating margin view to about 30%. That's up from 28%. And again, second quarter results. Second quarter adjusted EPS $2.12. The estimate was for $1.90 a share. Revenue of $8.60 billion. The estimate was for $8.53 billion. So again, here a beat on both the top and bottom line for its most recent quarter. The company raising its expectations for the third quarter, also raising its expectations for the full year. And Akiko, no surprise, we're seeing shares up just about 5.5%.
Yeah, this is certainly a very positive report when you consider the chatter around the cloud space for some time. In a lot of these earnings calls that we've gotten, we've heard about the pullback that we're seeing, especially in enterprise, in terms of tech investment or IT investment, I should say. And that's been led to concerns about what's happening in the cloud space. But this certainly seems to point to some positive outlook here, at least for Salesforce. Also looking here, Shauna, cash flow, cash generated up 142% year on year there too. So we'll see. We'll be listening to that earnings call as well. But at least for right now, we're seeing that stock up more than 5% right now. Well, coming up, short seller Jim Chanos is calling one EV maker a meme stock. The company's stock price has shot up since its public debut earlier this month. Find out which company earned the meme title this night.
Outlet centers are value shopping experiences for people that are looking to buy brands at the best possible price. And in this environment right now, that's what the customer is looking for.
Really the big issue here, two big issues. One, private companies in the sector, smaller companies, mid-sized businesses are being much more squeezed than their public counterparties, and the leverage position of companies is going to be the big story over the next 6 months, but really the next probably 24.
Spending is down, and that's going to put back to school shopping at risk, and back to school shopping is a bellwether of what's ahead for Christmas and holiday shopping.
We've seen a significant uptick in organized retail crime, and it's certainly impacting the profits of organizations. So we need to educate folks on what organized retail crime actually is. And these are individuals and groups going into stores, stealing massive amounts of quantities of merchandise in various stores day in and day out.
These smash and grabs, or they've been called mobberies, are very lucrative and very successful for them. And so until there are things put in place to mitigate damage or to resist this current surge, there's going to be an increase in these type of activities.
It's those retailers that are careful with their money in the years leading up to whatever downturn you're looking at, are the ones that have a better chance of turning things around.
The consumer continues to be concerned about inflation. Promotions, pricing, and so forth are certainly top of mind. There's a price sensitivity on the part of consumers, but they continue to spend.
Comparing Walmart to Target directly is something of a false equivalency. They're very, very different businesses. And in an environment where consumers are stretched and just trying to cover the essentials, Walmart, who is the biggest grocer in the world, is going to benefit tremendously from that disproportionate focus.
I'm in agreement. Trend that we've been seeing a lot with Walmart is that membership number. Not only have they been gaining new customers, but they've been able to keep the existing customers. And that in return is turning into loyal to consumers that are now extending themselves.
The consumer this year has been much more cautious, looking for deals, looking to trade down, looking to buy lower priced items within category, and to buy smaller baskets.
2022 and the early part of 23 were challenging across the board. There were only one or two luxury players that weren't hit in North America. But when I look in recent weeks and when I look at the forecast for the rest of the year, I think we have turned a corner.
The future of retail is media, and the future of media is retail. I think as you look to the future, like a year from now, you're going to start seeing that these retailers are driving content shoppable experiences.
Vietnamese EV maker VinFast quickly becoming one of the most buzzed about stocks since its IPO earlier this month. That stock down today, but it has surged since its debut. But the stock extending Tuesday's decline after famed investor Jim Chanos called VinFast a meme stock. I spoke with VinFast CEO on the day the company went public about the company's path to profitability.
So far, our shareholders have invested almost $10 billion into the company. We got the commitment of $2.5 billion more from Vin Group and our chairman. So we believe that with all the investments and the strategy that we have pursued, we are on the right path to profitability.
So where does VinFast fall in the meme trade? Here to discuss this and more, we've got Tom Bruni, StockTwit's senior writer. Is it a meme stock?
Hey, thanks for having me. Yeah, it certainly is. I think a meme stock is defined pretty much as anything that has widespread retail investor attention and participation. And there tends to be a huge disconnect between what's happening in the security's price and the underlying business. And we're certainly seeing that with VinFast because as you said, it surged from $10 to over $90 recently, making it the third largest automaker globally at a $200 billion valuation. And yet it only expects to produce about 40,000 cars this year.
Tom, what is it, though, that's attracting the attention from the retail traders? Why do they like a name like VinFast?
Yeah, so I think, just in general, retail investors are looking for kind of investing in the future, things that are going to change change the world and hopefully pay off as an investment. So the electric vehicle space has always been something that they've been interested in. At the end of the day, everyone's looking for the next Tesla. They want to invest in, whether it be Fisker or VinFast. They're looking for this startup in the space that's going to grow with the same potential as Tesla.
Yeah, I mean, it feels like this is a story that we have seen before with other EV makers, but I wonder how much of the stock moves have been exaggerated just because of the limited number of stock that's available. There's been much made about the fact that Vin Group, which is the parent company of VinFast, their chairman has an outsized stake in VinFast.
Yeah, I think that's the real story here. I'd be hard-pressed to say that the $200 billion valuation is justified based on where the business is. But if you look at kind of how the company is structured, through its SPAC, it offered about 17 million shares for the public to trade on the NASDAQ. But that's only 0.3% of the company's total shares. The rest are closely held by VinFast Group CEO and founder. So there's not a lot of availability for the public to trade, and if you've got a lot of demand and not a lot of supply, that tends to drive up the price.
Tom, what are you seeing on StockTwits specifically, just in terms of the interest and how that certainly, I would guess, has changed dramatically in even just the last couple of days?
Yeah, for sure. So over the last month or so since it came public, it's grown to about 5,000 people having it on their watch list, which is no small feat for only being a month old. Additionally, it's one of the most highly active streams on our platform, so people are definitely participating in the conversation, and a lot of people are just waiting on the sidelines trying to figure out what's actually happening here.
You know, we've been following sort of the meme trade since, what was it, 2021, when we saw the incredible run with GameStop, but we've heard more and more that the retail trader today is a lot more sophisticated. It's not just about going after that meme stock. It is about investing in ETFs. I wonder what you have seen. I mean, take this VinFast as just one example, but are we seeing money still chasing these meme stocks, or are we seeing it broaden out if we're talking strictly the retail investor?
Yeah, so I think it depends on the retail investor that we're talking about. Everyone has different goals and objectives in the market. Some people are traders, some people are longer term investors. So it really depends. For the traders, they're definitely gonna stick around and play these meme stocks, especially when there's news, because at the end of the day, volatility in these stocks create opportunity for those short-term traders. And then you also have a subset of longer-term investors. A good example is in AMC, right? Now that kind of the imminent bankruptcy is off the table, you have this group of people that believe in the iconic brand, believe that movie theaters will come back as a major business. They're trying to figure out, now that the dust has settled, what is the true value of AMC, and can this company really turn itself around? So I think there's a good mix of both short-term participation from the traders and longer-term focus from actual investors.
So Tom, I think I know the answer to this question, but this meme phenomenon, we certainly have been talking about it so much over the last couple of years. Is this something that you think is here to stay?
Yeah, absolutely. I think just with the way that communication and information is disseminated in today's world, both on social media, whether it be StockTwits or Reddit or Twitter, and we live in an age where Gen Z and millennials are interested in investing more than previous generations. They're taking control of their financial future, and they're trying to find opportunities. So I think the trend is here to stay. Honestly, the fact that we're talking about it here at the end of 2023 is kind of a testament to that. It's just a matter of which stocks become meme stocks, because it's kind of a moving target. We had Tupperware Brands, we had Yellow with their bankruptcy recently. So there's always going to be money flowing into some sort of company that's defined as a meme stock. So,
Tom, we didn't even talk about investors who are still buying into Bed Bath & Beyond, but that is for another conversation. Tom Bruni, StockTwits senior writer. Good to talk to you today.
Thanks for having me.
Well, coming up, we're going to go around the horn with today's top stories. Allie and Josh, what do you have on tap?
Well, Kiko, it hasn't been a cruel summer for the U.S. economy, at least not yet. But could it be a cruel winter?
A lot of that's been thanks to Taylor Swift, right? Well, now with the Eras Tour gone, we're going to talk about the next era of the U.S. economy up next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer, proud Supermanian. And let's kick things off with CNN because we finally have a new head of that network after the firing of Chris Licht. That would be Mark Thompson, and he has a pretty impressive resume. He was a former chief executive of the New York Times. He was also director general of the BBC, and now he will be leading CNN through this next transition. CNN has been going through a lot. We have the demise of CNN Plus not too long ago, just 1 month after its launch. Now we have CNN Max, which will be integrated into the Max app overall, which is sort of a risk for Warner Brothers Discovery, not launching it as its own standalone service, but integrating that into Max to try and create that stickiness. But, you know, that's not the only issues. We've seen CNN struggle on the rating side as well. So a lot of challenges here at this network. We'll see if Mark Thompson can get it done.
Yeah, I mean, two things that stand out to me immediately is we've talked about CNN trying to get more to the middle, right? That was part of the goal that they've had on the news side. When you think about the New York Times and the BBC, at least in my opinion, have been traditionally in the middle type news networks that do great news and break great news and do good investigative news. So if that's where CNN wants to go, I think you have the right head there. And then we were just showing Mark's resume, and when you take a look at that and think about building out the New York Times digital arm over the last decade. Think about how successful the New York Times has been digitally compared to some other papers. That is not the story of the New York Times is not papers are failing, they haven't been able to figure it out. It's been innovation. It's been a big drive to more online subscribers. So when you think about CNN trying to do something a little bit different with news, having someone that's been innovative and been successful in the past, taking sort of an older school news medium and bringing it to something different is appealing to me.
Yeah, I mean, Mark Thompson, more of a natural fit there for CNN. You mentioned that digital subscription service, right? They built out that business, huge. And then also BBC, the BBC iPlayer, that's a big thing out there, kind of developing that digital arm for all that programming, news, and also just all their drama, comedy, all that stuff that they do at BBC. So great fit there, I think, for CNN, Mark Thompson. I mean, he's a little bit older, but he has the pedigree, the resume. I mean, Chris Licht was a morning news, late night news sort of producer, kind of a more creative pick, but Mark Thompson, I think, would be just more of a natural, here's what we need to do, let's get it done. And I think a lot of the rank and file at CNN is much happier with this pick.
Well, the distinction you just made is something we talked about when we talked about the difference 2 weeks ago between CNN Plus and CNN Max, right? And what they're trying to tell us about the difference between CNN Max and CNN Plus. This points to that, with CNN Max being more of the traditional news play versus CNN Plus was kind of supposed to have that morning show feel to it, at least a little bit more from how I understood it. So a little bit more talk show based, right? A little bit more
lifestyle, yeah. And guess what? If it doesn't work out, David Zaslav, the CEO of Warner Brothers Discovery, he's made it very clear that if you're not a good fit, he's giving you the boot. He doesn't waste time. So Mark Thompson's going to have to do some changes pretty quickly, I think.
Yeah, for sure.
All right, guys, I want to talk about the economy, and I want to talk about Taylor Swift, and I want to talk about Barbie, because the summer's almost over, which means the story is finally almost over for us. But we're getting a couple more.
It'll never be over.
We're getting a couple more reports out that says it might be over. So the story I had my eyes on today was research out of Morgan Stanley saying that the boost that we saw from Taylor Swift, Barbie, and Beyonce, the combo of those three, so the Barbenheimer box office, and then also what Taylor Swift and Beyonce did on their tours, is going to contribute to, you see there, Q3 PCE, but then it's also going to contribute to a pretty significant drop-off when you take a look at Q4. So they're saying that $8.5 billion of U.S. growth could be attributed to those three major events, what they're calling these one-off events. And then when you remove those out, you're going to see a drop-off come Q4, and I just think it's interesting to think about the sort of the wrap, putting a bow on the strong consumer story we've talked about a lot this summer. We know Barbie and Taylor Swift have actually driven that. I think that that's something that we've talked about a lot too, is the box office sales are real, Allie. And so to see that actually play out, and then think about when you remove that from the economy, do you have another catalyst, or do we finally get the slowdown?
Yeah, and on top of that, we have the student loan moratorium expiring. I mean, that is going to create a significant lag as well. You'd want to hope that back to school shopping, holiday retail sales, that could be a bit of a boost. But we've heard from a lot of retail analysts that say that's expected to slow down. So a lot of headwinds heading into the back half of the year, especially when we talk about consumption. And I also think about the writer's strike and how we're having all of these major films delayed. Dune 2, which is a Warner Brothers Discovery movie that's been pushed into 2024. There's not really, like they were saying, that one-off driver in the back half of the year to convince people that maybe it's a time to save.
Right. Well, that was I was joking today with the editors about there being Barbie 2. And it was like, well, we don't know. And you're probably not going to get much
And
information on that in the current
it's hard to
environment.
recreate what Barbie was, the phenomenon around it, the marketing. I don't know if you can recreate that.
Yeah, it's kind of caught the right cultural moment there, but also Beyonce and Taylor Swift, like you mentioned, two massive live music draws that draw in so much money. And you know, Josh, I was looking at that one. That was it. Morgan Stanley? Is that what it was? That 1.9% quarter-over-quarter jump in PCE to a 0.6% drop in PCE quarter-over-quarter. That's insane. I can't believe. I didn't really realize the extent to the magnitude of what this spending could cause for the U.S. economy.
Well, it's interesting when you take a look at that graph too. Actually, the bigger lag on that graph is what you see in orange, which is the student loan moratorium. They're actually giving minus 0.8 to.
Oh wow!
Well, so that it's slightly bigger, that's interesting to me too. When you think about the overall story and sort of how we've conceptualized this in some of our stories online, when thinking about Barbenheimer and Taylor Swift, is it kind of put a nice face on what was a resilient U.S. consumer, and that's what we've been talking about in the overall economic story, right? So then when you remove that, now I think you're getting into the next phase, and you think about something more like student loans, and you think about the fact that the slowdown might be coming. If the spending stops at the theaters, if the spending stops at the concerts, then we can start to see that again. Again, a nice consumer-facing way to look at what is just an overall economic slowdown potentially.
And it's crazy. It just shows like the moratorium and the Beyonce Swift, the magnitude are both the same almost.
Yeah. Well, I was going to say with Taylor Swift, people were going to multiple Taylor Swift concerts, literally flying to different cities just to see her multiple times.
Which is so far beyond the ticket sales.
Yeah, and that's something, you know, we talk about Barbie not being able to potentially recreate that magic. Taylor Swift is another artist. How many other artists do you know that will fly all over the country to see an artist multiple times?
Like the fish
That's
effect.
Rare.
Yeah. Another topic that we're pretty big on, hot on, is of course the generative AI and reporting. In this case, you know, we've seen AP and Reuters use not AI, but sort of like a automated service for earnings reports, things like that. Well, it turns out Gannett with the Columbus Dispatch, maybe you've all heard of before, started using generative AI to produce these articles. You see one right here. Ohio State football games, very criticized here with the very lack of player names, lack of actual sort of descriptions, talking about how one invented close encounter of the athletic kind was used by the generative AI.
The final score was in the first two paragraphs twice. But I mean, as someone that used to write sports stories, you don't put the final score in the first two paragraphs twice.
Yeah, literally it was like Westerville up 7-0.
It repeats the same sentence.
And Warren scored a touchdown, went 14-7. There's no player names, nothing, no context. It was criticized by readers of the paper, rightfully so. Gannett is pausing this program. It's called Lead AI, I believe. It doesn't make sense right now. It's not working out. What are they doing?
It's interesting to me. I'm curious what the spend is here when you think about how much are they actually spending on the AI products, because what's the point? If it's going to be that bad, just put a box score up, right? All that's doing is just reading you the box score, getting the final score, which in local high schools does serve a purpose.
No stats.
Right, so just put the stats up. People want to see them for sure. Mom and dad want to see the stats in the paper, and grandma and grandpa want to read what happened in the football game, and we see who won. But just put the stat up then. What's the point of having AI play a role?
That's true. And I think about it from our perspective as reporters too. Look, you think AI could potentially help you when you're reporting. When you have to go, and this was the editorial guideline here, that they would have a human overseeing these articles to correct the mistakes. To me, that's adding more work. Rather than me just writing it myself. If I have to go back to these AI generated pieces and correct the mistakes, make it flow better, make it sound more human-like, that's a challenge.
Yeah.
Rather than me just writing it from the get-go.
The editor basically writes it now, right? I mean, a human, I guess.
So our jobs are safe for now.
I think they're safe.
For now.
That's what I'm taking.
They're safe, right?
Yeah.
I don't know. We'll see.
All right. Well, hopefully our jobs are safe, because on the other side of this break, we have more coming up on Yahoo Finance. Stay tuned.
Cannabis stocks getting a boost after U.S. health officials are calling for marijuana to be reclassified to a lower risk category. Here to break down the latest is Yahoo Finance's Anjali Kamlani. Anjali, how likely is this to happen?
Well, as of right now, there is a memo out to the DEA from the health department asking for this basically a declassification almost, which is what we know has been a focus in Congress as well. You've seen the moves around the country to declassify it or to make offenses regarding marijuana less stringent. And so that has been something that has been a focus, especially when it comes to the need for research around its use. And that's really the focus behind the health department's asking for it to move from a class 1 or schedule 1 drug into a schedule 3 and lowering the severity for its uses. And so that is what we know right now based on a report from Bloomberg, which saw the note. And so that is, like I mentioned, there has been a lot of Congress push in Congress to get these laws moved. We've seen around the country where marijuana is sold now, and it could really boost those stocks, as you saw on your screen earlier with this report, if it does in fact go through. And this is just another avenue to get that movement at the federal level, which has been slower than what we've seen at state levels.
Anjali, another story that I know you're following, this time with prescriptions, opioid overdose emergency treatment Narcan. It's going to be hitting shelves pretty soon this fall. What are the details there?
That's right. It is going to be available this fall, actually next month. So within a few days, the manufacturer's price from the producer, which is Emergent Biosolutions, is about $45, which some have commented could keep it out of reach from those who need it the most. It is used for opioid overdose treatments that includes from painkillers as well as drugs like heroin. So it's been used for many years in emergency departments, in first responders have been using it, and there's been a lot of community groundswell efforts to get it over the line, get it into the hands of those who need it, and now it can be used in homes. There have been, the FDA just earlier this year approved it for over-the-counter use. So relying less on, say, the manufacturers being able to supply it or community efforts to have it supplied in homes. This puts it right in the hands of the consumers for a price tag, of course. And there are concerns about whether or not insurance could play a role in this. Of course, once it gets to over-the-counter, that removes insurance coverage, but whether or not it could still be covered remains a question. So a lot of focus on this news right now, and it was initially supposed to come out actually in summer, but now we're seeing it come out next month. So good news for those who need it.
Very good news. All right, Anj, thank you.
Well, millions of Americans are set to face the return of student loan payments in October. This comes as the U.S. faces elevated inflation and higher rates. So how do Americans begin to tackle their debt? For more on that, we're turning to our next guest who was able to pay off more than $200,000 in debt in just 4 years. Joining us now to discuss is Cindy Zuniga-Sanchez, Zero-Based Budget Coaching founder and author of Overcoming Debt, Achieving Financial Freedom. It's good to talk to you today, Cindy. It's worth noting that this is something you're very familiar with, given the debt that you had to shoulder from going to law school. Walk me through the process of paying that down.
Yeah, I think that what I like to recommend people are to really see it as 3 main steps that you want to take. First, you want to go ahead and create your debt overview. Before you can actually tackle this, maybe large amount of debt, you have to know what you're working with here, right? So I recommend collecting these 4 pieces of information: your debt type, your debt balance, your minimum payment, and your interest rate. These 4 pieces of information are really going to be critical to set you on the path for overcoming that debt.
Cindy, how should people be thinking about the timeline? Because I think when they rack up a lot of debt, they get a little bit overwhelmed thinking about how long it could potentially take to pay off. So how should they be approaching that?
Yeah, I think when it comes to the time frame, the best thing to use is a debt repayment calculator tool. There are so many free options, including a really great one from Credit Karma, NerdWallet. If you have student loans, studentaid.gov has a loan repayment calculator. Use these free tools so that you can calculate, okay, with the payment that I currently have, how, by when will I become debt free? Really, your debt repayment strategy is going to be key here. So you can pick really one of two methods, the debt avalanche or the debt snowball method. The debt avalanche method, you're going to go ahead and pay off your high interest debt first, and then you're going to work your way down to the lower interest debt. Or you go with the debt snowball method, where you're going to pay off your smallest debt first and then work your way to your highest debt. By using this type of strategy, you're actually going to be able to give yourself a date by when to pay off your debt. And I think that having deadlines, having dates, and having this information written down is really quite powerful throughout this journey.
Cindy, I'm curious about your own personal journey, how you sort of went from being a lawyer to what it is that you do now and offering these personal finance coaching advice. I mean, what prompted you to go in this direction?
Yeah, I think that for me, as a Latina, as a woman of color, I didn't see much personal finance information really speaking to my community. And I thought that I didn't want to just share my personal story and yes, hey, I'm tackling down this debt, but I want to share the practical tools, the resources, the tips that I'm learning along the way as well with my community. And now we're seeing more and more diversity pop up when it comes to personal finance education, which is really crucial to really bridging that gap when it comes to financial literacy.
Cindy, you've done an incredible job of scaling your business pretty quickly. What are the plans? How do you plan to grow that business? And I guess, how do you approach social media and the various platforms as ways to reach your customer base?
Right. Well, social media has been incredibly powerful for growing my platform. Just think about how much time you and I spend on our phones, right? And the younger generations spend even more time on their phones, on their devices. So why not use that time to really, fill yourself with the knowledge that you need, practically speaking, for our day-to-day lives. So definitely social media and growing that platform, creating educational, relatable, but also entertaining content. I think sometimes people are intimidated by learning about money because they think that the information is very dry, very stiff. But in reality, it's really people like you and me educating our communities about this information that is truly so important to know.
Cindy Zuniga-Sanchez, it's good to talk to you today. Certainly a lot of people taking notes, especially with the resumption of those student loan payments. Thanks so much for your time.
Yeah, absolutely. Thank you so much.
Well, coming up, it is closing time here on Yahoo Finance. We're going to recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
Outlet centers are value shopping experiences for people that are looking to buy brands at the best possible price. And in this environment right now, that's what the customer is looking for.
Really the big issue here, two big issues. One, private companies in the sector, smaller companies, mid-sized businesses are being much more squeezed than their public counterparties, and the leverage position of companies is going to be the big story over the next 6 months, but really the next probably 24.
Spending is down, and that's going to put back to school shopping at risk, and back to school shopping is a bellwether of what's ahead for Christmas and holiday shopping.
We've seen a significant uptick in organized retail crime, and it's certainly impacting the profits of organizations. So we need to educate folks on what organized retail crime actually is. And these are individuals and groups going into stores, stealing massive amounts of quantities of merchandise in various stores day in and day out.
These smash and grabs, or they've been called mobberies, are very lucrative and very successful for them. And so until there are things put in place to mitigate damage or to resist this current surge, there's going to be an increase in these type of activities.
It's those retailers that are careful with their money in the years leading up to whatever downturn you're looking at, are the ones that have a better chance of turning things around.
The consumer continues to be concerned about inflation. Promotions, pricing, and so forth are certainly top of mind. There's a price sensitivity on the part of consumers, but they continue to spend.
Comparing Walmart to Target directly is something of a false equivalency. They're very, very different businesses. And in an environment where consumers are stretched and just trying to cover the essentials, Walmart, who is the biggest grocer in the world, is going to benefit tremendously from that disproportionate focus.
I'm in agreement. Trend that we've been seeing a lot with Walmart is that membership number. Not only have they been gaining new customers, but they've been able to keep the existing customers. And that in return is turning into loyalty consumers that are now extending themselves.
The consumer this year has been much more cautious, looking for deals, looking to trade down, looking to buy lower priced items within category, and to buy smaller baskets.
2022 and the early part of 23 were challenging across the board. There were only one or two luxury players that weren't hit in North America. But when I look in recent weeks and when I look at the forecast for the rest of the year, I think we have turned a corner.
The future of retail is media, and the future of media is retail. I think as you look to the future, like a year from now, you're going to start seeing that these retailers are driving content shoppable experiences.
Let's take a look at a couple of stocks that are trending after hours. 4 stocks for you on the board. Let's start with Salesforce because we're looking at gains of nearly 6% in extended trading. A very solid report here from the company, beating on both the top and bottom lines. Revenue up 11% on a year-over-year basis. The outlook for the third quarter was also better than expected, and Salesforce raised its full-year outlook. We're seeing the excitement reflected in the stock. And taking a look at how the stock has performed over the last couple months, over the last 3 months, we're looking at losses of just about 2%. Year to date, though, we're looking at gains of 62%. We know Salesforce has come under a tremendous amount of pressure from activist investors, pushing CEO Mark Benioff to address some spending concerns. He has made cuts, and we're expected to hear a little bit more about that on the call this afternoon. But again, a strong quarter for the company, and Benioff in this earnings statement say that the transformation is driving these strong results, and Salesforce is leading customers into the new era of AI. All right, so we're looking at Salesforce up just about 3%. Chewy is also in after hours. It's actually moving to the downside. We're looking at losses of just about 1%. The results weren't that bad. Revenue beating the street's expectations, $2.78 billion. That's actually up 14% on a year-over-year basis. Sales per active customer was $530. That's up 15% from a year ago. But some questions just about the macroeconomic environment, what that could mean for Chewy and demand here from customers, at least in the short term. Chewy also saying that it did gain some share in the industry. Year to date, though, looking at losses of just about 26%. Five Below, another read here on the consumer. The discount retailer off just about 6% in extended trading, falling after cutting its profit outlook for the year, lowering its guidance in part because of shrink. Now, this has been a common theme among retailers this earnings season. We know shrink, a lot of that is linked to retail theft, something that many of these retailers have been struggling with now for quite some time. Year to date, the stock essentially flat, up just about 3%. And rounding it out with Okta, the ID software company, that's surging in after hours, up just about 10%. Revenue and earnings beating here, so beat on both the top and bottom line. The company raising its full year revenue and profit forecast, citing better IT spending. So some of the concern that management has been talking about over the last couple of quarters, not really showing up, at least in these results. The stock well off the highs that we've seen up since the start of the year, but still in the green since January 1st, up just about 7.5%.
Well, it is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Sam Bankman-Fried's fraud trial could be pushed back. A judge in New York raising the prospect of a delay after SBF's attorneys argued they didn't have enough time to review millions of pages of evidence to build his case. The judge says there is no guarantee the request for a delay will be granted. The trial is scheduled to start on October 3rd. The Labor Department's proposing new overtime rules that could affect millions of salaried workers. The Biden administration is looking to guarantee overtime pay for workers earning less than $55,000 a year. About 3.6 million workers would now qualify to get at least time and a half after working 40 hours. The current threshold is just over $35,000 a year. The Labor Department says there would be a transfer of $1.2 billion from employers to employees if this rule goes into effect. And finally, CNN has a new CEO. Warner Brothers Discovery announcing Mark Thompson will be the next leader of the cable news giant. Thompson comes after Chris Licht's rocky and short-lived tenure as CEO. Thompson previously led both the New York Times and the BBC.
Here's what to watch tomorrow. Ahead of the open, we look at the latest PCE data, the Fed's preferred inflation gauge, and that could give us a better clue about the Fed's plans for rates. PCE is expected to tick up slightly to 4.2%, and the core figure to stay unchanged. We'll also get initial jobless claims, and data on personal spending and income claims are expected to rise to 235,000. Earnings before the bell, a number of earnings results are on tap. Before the bell, we're going to hear from Dollar General, Campbell Soup, Hormel, and Polestar Automotive. Dollar General's report coming at the tail end of a mixed earnings season so far for retailers. Now, its main competitor, Dollar Tree, issuing guidance below the street's expectations, warning that customers are trading down, but theft, though, is pressuring profits. After the bell, Broadcom, Lululemon, Dell, and VMware are set to report. Lululemon sales are expected to rise 15% as it sees more interest due to innovation and its loyalty program. Dell is expected to see revenues rise slightly to around $20 billion, but analysts, though, warn that their call may not be filled with too much optimism. The company could see a steeper decline in server and storage infrastructure. Well, that does it for us today on Yahoo Finance Live. I'll see you right back here again tomorrow. Have a good night.